Hey, what's up, stock compounders? Brad here. So today I'm going to summarize Chapter 8 of The Intelligent Investor by Benjamin Graham. Now, Chapter 8 is one of two chapters that Warren Buffett recommends all investors should study and master. So Chapter 8 is The Investor and Market Fluctuations. So the first thing I'm going to do is read the most important paragraph in this chapter. And then I'm going to kind of go through the summary and then kind of hit some of the bigger points of the chapter. So here's the most important paragraph in this chapter. The true investor scarcely ever is forced to sell his shares, and at all other times he is free to disregard the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his portfolio. So if the price of the market is absurdly low, it's an opportunity to add shares, add ownership interest at a low price. If the price is ridiculously high, it's a chance to sell, at a large gain. Thus, the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other persons' mistakes of judgment. And then I'm going to go through the summary here. So the most realistic distinction between the investor and the speculator is found in their attitude towards stock market movements. The speculator's primary interest lies in anticipating and profiting from market fluctuations. The investor's primary interest lies in acquiring and holding suitable securities at suitable prices. So speculator, it's all about forecasting. It's all about guessing what's coming next. For the investor, it's about understanding how the value of a share of stock compares to the market price of a share of stock. That's the whole concept of margin of safety, buying at a significant discount from the value of a share of stock. Market movements are important to him in a practical sense because they alternately create low price levels at which he would be wise to buy, and high price levels at which he certainly should refrain from buying and probably would be wise to sell. Okay? Now this is the inverse of what most market participants do. As the price goes up, they look at that and think, oh, this must be a great business because the price is going up. They look to market fluctuations to instruct them on how to invest. That's really the opposite way from how intelligent investors approach things. On the whole, it may be better for the investor to do his stock buying whenever he has money to put in stocks, except when the general market level is much higher than can be justified by well-established standards of value. So, this is getting at, don't try to time the market, okay? Put money in as it comes in. If you make a monthly deposit or weekly deposit from your income into your stock market portfolio, Graham is recommending deploy that money as it comes in, unless the market is much higher than can be justified by value standards. And that's more the exception rather than the rule when that's the case, kind of when the market is in bubble territory. So, he also talks a lot about how when anyone who owns a stock portfolio, the prices are going to fluctuate quite a bit over a period of years. And that's just the nature of the game. It's nothing to be concerned about. It's not necessarily that the value of the businesses that you own are fluctuating. It's the sentiment of the market, the mood of the participants in the stock market are what's making that price fluctuate to a large extent. So that's why we really can't look to market prices to instruct us, because more often than not, market prices, the direction of market prices will mislead us rather than help us make intelligent investment decisions. So that's kind of a general summary. I want to go through some of the bigger themes. The investor should know about the possibilities of wild fluctuations in stock prices and be prepared for them both financially and psychologically. So the financially piece is, don't have money invested in the stock market that you're going to need in the short term, because there's a very good chance that, when you need to take that money out, your portfolio may have taken a dip that's not related to the fundamental financials of the businesses that you're invested in, that could just be related to the mood of the market. So, make sure it's not money you need in the next 3 to 5 years, ideally even longer than that. So that's the financial piece. And then the psychological piece, again, it's really just realizing the market is here to serve us, not to instruct us. The market, think of it as your kooky uncle, right? Who, you guys are in business together. Fortunately, he doesn't have any management decisions. He's just the kooky kind of passive investor. And every day he's throwing prices at you. He's saying, hey, I'll sell you more shares of this business at this price, or I'll buy yours at this same price. So every day he's hurling prices at you, and they fluctuate wildly, right? It's not based on the fundamentals of the business. They're just all over the place. So we have a choice to ignore him when the prices don't serve us, right? Because the prices, we're not using them to instruct us. But we have the benefit that when there's a price that he throws at us that can be an advantage, like if the price is really high and we want to cash out some shares at that price, that will benefit us. Or if the price is super low and we'd love to own more of the business at that super low price, those are opportunities that we have in the stock market that we wouldn't have if we owned, say, shares in a private business where we don't have that liquidity to buy and sell each day at a fixed price. So that's the advantage of investing in public companies through the stock market, is that we always have opportunities to act. The key is to know when it's smart to act on those opportunities, okay? And to not use those numbers to instruct us. So that's the whole thing about market fluctuations as a guide to investment decisions. So this is interesting. There are two possible ways by which we may try to profit from the pendulum swings, the stock price swings. One is by way of timing, and the other is by way of pricing. By timing, we mean the endeavor to anticipate the action of the stock market. And Benjamin Graham firmly believes that that's a fool's errand. We can't predict the future prices of the stock market, okay? But pricing is something that intelligent investors can do. They can affect the outcome of that game by understanding what the value of a business is, based on its, financial, like what it's doing, what the earnings are into the future, how strong the economic moat is, what is the competitive advantage. We can analyze the income statement and balance sheet and cash flow statement and put together, a reasonable approximation of what the value of a share ownership of that business should be. And then, we can wait until the price, makes sense for us to act on. Okay, that's really how intelligent investors use the stock market and those wild price fluctuations of the stock market. So that's that piece. Timing. So this is talking about timing versus pricing. Timing is of great psychological importance to the speculator because he wants to make his profit in a hurry. Okay. The idea of waiting a year before his stock moves up is repugnant to him. He's so impatient to make that money. But a waiting period as such is of no consequence to the investor. Okay? Because the investor is looking at it, okay, I'm buying an ownership share in this business. And I know, the financials of the business, they don't change week to week, even month to month. I need to wait in order to actualize that benefit, that I'm invested in a great business at a good price. I know it's going to take a couple of years for that to pay off, at least a couple of years. Hopefully I'm in a business that's a long-term compounder, and I just want to leave it there for decades rather than trying to find a new investment every couple of years. So that's kind of the difference between timing and pricing. So this section talks about buy low, sell high approach. We are convinced that the average investor cannot deal successfully with price movements by endeavoring to forecast them. And it talks about, looking at past market cycles and trying to figure out, okay, when these indicators are met, that means the market is low and I should buy here. And when these indicators are met, that means, the market is high and I should sell there. But the formula plans, there's not enough consistency in market cycles to be able to identify or create formulas based on past cycles that will reliably work moving forward. There's too much fluctuation, and as often as not, you'll end up selling when you think it's high, but then the market goes on to double or triple from there, and you're sitting on the sidelines that whole time because you were expecting the market to dip. So it's just not a reliable game to play, the whole timing thing. Let's see what else. In any case, the investor may as well resign himself in advance to the probability rather than the mere possibility that most of his holdings will advance, say, 50% or more from their low point and decline the equivalent 1/3 or more from their high point at various periods in the next 5 years. So this is just talking about natural price fluctuations. And the reason he says, up 50%, down 33% is because if your portfolio drops 33%, say from $15 to $10, you need a 50% increase to get back to even. Okay? That's a big reason why Warren Buffett's rule number 1 of investing is don't lose money. Okay? Because the amount you lose, if you drop 50%, now you have to make 100%. Okay? So it's really important to focus on minimizing the downside when it comes to investing. And the way to do that from a value investing perspective is to insist on a significant margin of safety when you're buying. Determine what the value is and make sure you're buying significantly less than that value. This is also very interesting. So there's a section here that talks about the psychology of your share price advancing. He says, your shares have advanced. Good. You are richer than you were. Good. But has the price risen too high, and should you think of selling? Or should you kick yourself for not having bought more shares when the level was lower? Or, worst thought of all, should you now give way to the bull market atmosphere, become infected with the enthusiasm, the overconfidence, and the greed of the great public, of which, after all, you are a part, and make larger and dangerous commitments? And it says, even the intelligent investor is likely to need considerable willpower to keep from following the crowd, to get pulled into these psychological influences of, following the herd. As prices are going up, 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 that means more and more investors are piling in. That means there's more buying, right? There's more demand, okay? There's a fervor. People don't want to miss out. It's hard not to get sucked into that. But that's an incredibly important task for the intelligent investor. Yeah, so that's right. So it talks a little bit about liquidity here. So what does liquidity mean? What liquidity really means is, first, the investor has the benefit of the stock market's daily and changing appraisal of his holdings for whatever that appraisal may be worth. And second, that the investor is able to increase or decrease his investment at the market's daily figure if he chooses. Thus, the existence of a quoted market gives the investor certain options that he does not have if his security is unquoted. Okay? This is the advantage that we have as stock market investors. But people turn it into a disadvantage by being influenced by the price movements, being scared away if the price goes down, even though stocks are on sale. If you're going to be investing in the stock market for decades moving forward, in other words, if you're early in your stock investing career or endeavor, you really want prices to drop. You want the businesses you own to go on sale. Okay? Like that's the ideal for you. Because then you have more and more ownership of that business at a discount. Like that's an incredible situation for an intelligent long-term investor. So keep that in mind when you see on the news, prices are plunging, red. No, that's good if you have many years ahead of you in the stock market. That means you need to be doubling down on your investments, okay? Because as prices drop, the return prospects of that business, assuming the drop in prices aren't related to some issue with the business, your return prospects go up the cheaper you're able to buy in at. So that's a fantastic situation. That's why Warren Buffett, he says, I love when prices go down. He talks about hamburgers. He uses an analogy. When the price of hamburgers drop in the Buffett household, everyone cheers because they're going to be buying hamburgers for the rest of their lives. So why wouldn't they want the price to go down? It's the same with stocks. If you're a long-term investor, we want the price to go down. Okay. Yeah, I think that's probably good, guys. Let me know if you have any questions about Chapter 8 of The Intelligent Investor, the investor and market fluctuations. It's just so important to view the market as there to serve you, to take advantage of when prices are favorable. Both if they're crazy high, it gives you an opportunity to sell. If they're crazy low, it gives you an opportunity to buy more. Okay? If that's what you take away from this, you're going to be such a better investor than most investors out there who are just chasing price. Okay, so I'll leave it at that. Thanks for tuning in all the way to the end here. Smash that thumbs up if you appreciated this kind of analysis of Chapter 8 or summary of Chapter 8 of The Intelligent Investor. And I will see you guys in the next video. Take care.